Imagine taking your car to a mechanic. Or you just had a pretty nasty fender bender.
Oh yeah, we've all been there. It's the worst.
Right, and the bumper is like hanging by a single thread. The hood is completely crumpled up.
Your radiator's hissing at you.
Exactly. And frankly, the engine sounds like it's just grinding rocks. So you're standing there in the garage, sweating, just bracing yourself for absolute financial ruin.
Just waiting for that massive bill to drop.
Yeah, a bill that is going to wipe out your savings for the entire year. But then the mechanic walks out, wokes the grease off his hands, looks you dead in the eye, and says, actually, you left a briefcase with $1 million in the trunk, and the engine just needed a quick software update. You're totally good to go.
Which is, I mean, that is the exact whiplash Allstate investors are feeling today.
Welcome to the deep dive. Today, we are targeting Allstate Corporation, ticker symbol ALL, and we are breaking down their Q2 2026 earnings call.
And this is a quarter where management essentially took a brutal, industry-crushing inflationary environment, chewed it up, and spit out an absolute masterclass in operational efficiency.
It really is. I mean, our mission here is to cut through the Wall Street jargon and deliver the most crucial takeaways for you. We want to help you decide if this stock is a buy, a hold, or a fold.
Right, because we are talking about a company that navigated a perfect storm of supply chain failures, surging repair costs, and skyrocketing medical inflation, and somehow came out the other side, essentially printing cash.
Yeah, and that is not hyperbole. Like, at all.
No, not at all. When you dig into the underlying data, and I mean not just the headline figures, but the actuarial tables, the reserving strategies, the structural technological shifts, you see a business model that has fundamentally detached itself from the struggles of its peer group.
So let's just get straight to the raw numbers, because frankly, they look like typos at first glance.
They really do.
Total revenues for the second quarter hit $18.6 billion. Right. That is an 11.8% increase year over year compared to the second quarter of 2025. $18.6 billion in a single 3-month period.
And you have to remember, top-line growth in a mature insurance carrier is usually this really slow, grinding process.
Yeah, it's not a high-growth tech startup.
Exactly. So an 11.8% jump implies they are capturing a massive volume, pushing through necessary pricing actions from prior periods, or, you know, a combination of both.
But the revenue is just the top of the funnel. What actually flows down to the bottom line is where the story really gets crazy. Net income for the quarter was $3.2 billion.
But hold on, we know the market doesn't usually price off straight net income, right?
Right, because it includes a lot of noise, like one-time accounting shifts or unrealized investment gains. So let's look at adjusted net income, which is the number Wall Street actually models.
Yeah, and adjusted net income came in at a massive $2.3 billion. To put that in per share terms, that translates to an earnings per share, or EPS, of $8.99 for the quarter.
An EPS of almost $9 in a single quarter.
It's staggering.
Let's stretch that timeline out for a second just to capture the momentum here. For the first half of the year, the source material notes they hit an adjusted net income of $5.1 billion, or $19.65 per share.
Which is just a massive run rate.
It is. And here's the metric that actually made me physically stop reading and check the math. The trailing 12-month adjusted net income return on equity is sitting at 44.2%.
A 44.2% return on equity in the insurance sector is, I mean, it's almost unheard of.
It really is.
To give that some context for you, a highly efficient, well-run property and casualty insurer usually targets an ROE somewhere in the low to mid-teens.
So like 12 to 15% is considered great.
Exactly. Operating at 44.2% means they are generating almost half the value of their entire equity base in pure profit over just a 12-month period.
Yeah, I have to throw a flag on that ROE figure immediately, though.
Fair enough.
Because when I see a 44% return on equity in a legacy financial institution, my first instinct isn't to applaud.
It's to be suspicious.
Right. My first instinct is to ask, wait, are they taking on insane amounts of risk? Are they leveraging the balance sheet to the moon just to generate those returns? Because in finance, abnormal returns usually require abnormal risk.
And that is the exact right lens to view this through. High ROE can absolutely be a symptom of dangerous leverage or reckless underwriting.
So how do we know they aren't just gambling?
Well, to determine if that's the case here, we have to look at how they are generating that profit. In the insurance industry, the defining metric of operational health, like the ultimate lie detector, is the combined ratio.
Yes. Let's break down the mechanics of the combined ratio because it is the single most important concept we're going to talk about today.
It really is. So the combined ratio is essentially an efficiency score. It measures how much money an insurance company is paying out in claims and operating expenses compared to what they are taking in from premiums.
Okay, so it consists of two parts, right?
Right, the loss ratio and the expense ratio. The loss ratio is the percentage of premiums paid out to cover actual claims. So fixing crushed bumpers, paying medical bills, settling lawsuits.
And then the expense ratio is the cost of running the actual business itself.
Exactly. Paying the actuaries, keeping the lights on at headquarters, running those TV commercials everyone sees, and paying commissions to agents.
Got it. So you add those two ratios together and you get the combined ratio.
Precisely. If the combined ratio is exactly 100, the company is basically breaking even on its core business. They are spending exactly $1 on claims and expenses for every dollar they collect in premium.
And if the ratio is over 100,
then they're actively losing money on the insurance side. It means they're paying out, say, $1.05 or $1.10 for every single dollar they take in.
which forces them to rely entirely on the returns from their investment portfolio just to stay afloat.
Right. But if the combined ratio is under 100, they're generating an underwriting profit. They're making money on the pure act of selling insurance before they even touch a dime of investment income.
So the goal is always to keep that number as far below 100 as humanly possible without alienating your customer base or losing market share to cheaper competitors.
And this quarter, Allstate's property liability combined ratio was 86.6.
86.6.
Yeah, that is a 4.5-point improvement from the prior year.
Let's translate 86.6 into hard dollars and cents for a second. That means for every single dollar Allstate collected in premiums across its entire property and liability portfolio, they only spent 86.6 cents on claims, salaries, technology, and marketing combined.
Which leaves a lot of profit.
Right. They get to keep 13.4 cents of every dollar as pure operational profit. In an industry built on razor-thin margins, a 13.4% margin is an absolute fortress.
It is. But the narrative gets even more dramatic when we isolate the core of their business, which is the auto insurance segment.
And auto insurance is notoriously difficult to price accurately.
Incredibly difficult, because the frequency and severity of accidents are constantly shifting, yet Allstate's auto combined ratio came in at 83.3.
Wow.
Yeah, they improved that specific segment by 2.7 points from the prior year.
So in auto, they are keeping 16.7 cents on every premium dollar. Yeah. Okay, I have to push back here again. I have to put on my skeptical investor hat.
Go for it.
Because an 83.3 combined ratio in auto insurance feels completely anomalous. Is this actually sustainable? Or are we just looking at a one-time accounting fluke that is distorting the reality of their ongoing operations?
Honestly, it is not a sustainable long-term run rate. And to be perfectly clear, even Allstate's management acknowledges this reality.
Okay, that's good to hear.
Yeah, their historical long-term target for auto insurance is to operate in the mid-90s across a full market cycle. So operating at 83.3 is a blowout performance that implies massive temporary outperformance relative to those historical norms.
Right, because if they consistently run at a 95 combined ratio, they're making a 5% margin on underwriting. And given the billions of dollars in premiums they collect, a 5% margin still generates a phenomenal return on capital.
It easily supports dividend growth and share repurchases, yeah.
But at 83.3, they aren't just running a good business. They are operating a toll booth where literally no one is asking for change.
That's a great way to put it. And to fully grasp how wild that 83.3 number is, you really have to look at the macroeconomic context.
Let's do it.
The earnings call highlighted a 10-year track record. Over the last decade, Allstate's auto insurance business achieved an average combined ratio of 95.2.
Which proves they are highly disciplined underwriters over long time horizons.
Exactly. But over that exact same 10-year period, the broader auto insurance industry as a whole did not make an underwriting profit at all. The industry average combined ratio was over 100.
So the average insurance company has essentially been subsidizing its customers' driving habits for a decade, relying entirely on investment float to turn a profit.
Exactly. So even at their normal historical level of 95.2, Allstate radically outperforms the pack. But 83.3 is a massive deviation even for them.
So it demands that we look deeper into the mechanics.
It really does. We cannot just blindly extrapolate an $8.99 quarterly EPS into perpetuity. We have to figure out if these earnings are a temporary sugar high or if there has been a permanent structural shift in their cost base.
Which brings us to the most complex and frankly the most contentious part of this earnings report. To understand how they achieved an 83.3 combined ratio, we have to talk about reserve releases.
Yes, reserve releases are the primary catalyst driving that massive outperformance this quarter.
And for anyone who doesn't live and breathe actuarial science, insurance accounting can feel like a complete dark art.
Oh, absolutely. But the concept is actually quite intuitive once you break down the timeline of how an insurance claim works.
So let's break it down. I want to understand exactly how a reserve release generates billions in profit.
Okay, so during this quarter and for the year to date, Allstate benefited from $1.5 billion in auto claim reserve releases.
$1.5 billion.
Yeah. And this specific accounting mechanism benefited their second quarter combined ratio by 2.4 points.
So without this $1.5 billion injection, their combined ratio would have been closer to, what, 85.7?
Exactly. Still incredible, but the reserve release is doing a lot of heavy lifting here.
Let's use a real-world analogy. I like to think of a reserve release like finding a massive wad of cash in your winter coat pocket from last year. You know that feeling?
Oh, best feeling in the world.
Right. You reach in, you find a $50 bill you completely forgot about, and suddenly you have extra spending money. Except in this case, Allstate reached into their corporate winter coat and pulled out $1.5 billion.
It's an apt analogy, but we need to explain why that massive pile of money was sitting in the coat pocket in the first place.
Yeah, why did they hide it there?
This goes to the core of how actuaries price risk. When an insurance company writes a policy today, they are taking your premium cash up front. But they are making a promise to pay for an accident that might happen 6 months from now.
Right. And even after the accident happens, it might take another year to settle the medical bills or actually fix the car.
Exactly. So they are collecting known cash today to cover unknown costs tomorrow. Because those future costs are unknown, actuaries have to estimate them.
Using incredibly complex statistical models, I imagine.
Oh, incredibly complex. They predict how many crashes will happen, how badly the cars will be damaged, and how much the medical treatments will cost. And based on those predictions, they are legally required to set aside a specific pile of cash to ensure they can eventually pay all those claims.
And that pile of cash is called the reserve.
You got it.
And predicting those future costs accurately has to be the hardest job in the building. If you underestimate the costs, you go bankrupt when the claims roll in.
Right, but if you overestimate the costs, you tie up capital that could be used for growth or returned to shareholders.
So they have to walk a really tight rope.
Exactly. Now, let's rewind the clock and look at the macroeconomic environment in 2023 and early 2024. If you recall, the period following the pandemic was an absolute nightmare for the auto insurance industry.
It was a perfect storm of inflation.
It really was. We saw an unprecedented supply chain collapse. Used car prices, which dictate how much an insurer has to pay when a vehicle is totaled, surged by nearly 60%.
60%? That's insane.
Yeah, and parts costs skyrocketed. Supply chains for simple things like microchips, windshields, or replacement bumpers completely ground to a halt.
Which meant that cars were sitting in repair shops for months, just waiting for parts. And while that car sits in the shop, the insurance company is on the hook paying for the customer's rental car day after day after day.
Precisely. The severity of the physical damage claims was spiraling completely out of control. And on top of that, driving behaviors had changed post-pandemic.
Oh yeah, people forgot how to drive.
Basically. Accidents were happening at higher speeds, leading to more severe injuries, which meant higher medical payouts and far more frequent litigation.
So Allstate's actuaries are sitting in a boardroom in 2023, watching inflation absolutely rip through their cost structure. And they have to decide how much cash to set aside for claims that haven't even been fully reported yet.
And they did what a highly disciplined management team does. They prepared for the absolute worst.
They assumed the winter was going to be brutally cold.
Exactly. They modeled for severe, sustained runaway inflation. They assumed that parts would stay incredibly expensive, that labor rates at body shops would keep climbing, and that medical severity would remain elevated. So they set aside a massive mountain of cash.
So going back to the analogy, they stuffed every single pocket of that winter coat with cash just to be safe.
They stuffed their reserves full. But here is the pivot. As time passed, we moved into late 2024 and 2025, and those actual claims from the 2023 period started to finally get settled and closed out.
And what happened?
The real-world costs came in much, much lower than those worst-case estimates.
The inflationary fever started to break.
Exactly. Used car prices cooled off significantly. The supply chains untangled, so parts became cheaper, and cars spent far less time in the shop, slashing those rental car costs.
And I bet the claims management team got highly efficient at routing repairs to cheaper in-network shops, too.
They did.
Okay, here is where I want to challenge the quality of these earnings, though.
Okay, let's hear it.
When an insurance company realizes they oversaved for a rainy day, that extra cash flows straight back to the bottom line as profit in the current quarter, right?
Right. That is what a reserve release is.
But doesn't that mean that $1.5 billion of Q2 profit isn't actually a reflection of how well they're operating today? Isn't it just a massive accounting true-up correcting their overly pessimistic math from 2 years ago?
That is a very common bear argument. You could definitely argue that these aren't real operational earnings generated in Q2, but rather shifted earnings from prior years.
Right.
However, you have to look at the alternative. If they hadn't been conservative in 2023, they would have reported artificially high profits back then, only to face massive, devastating reserve additions today, which absolutely crushes a stock price.
So you were saying we should view the reserve release not as a fluke, but as proof of a bulletproof balance sheet.
Exactly. Releasing reserves proves that their balance sheet is pristine. When they adjusted their 2023 numbers retroactively to account for this $1.5 billion release, their underlying combined ratio for that terrible year actually improved by a massive 7.2 points.
Wow.
Yeah, bringing it down to 95.2.
Wait, really? So even in the absolute worst inflationary environment in modern auto insurance history, their true retroactively adjusted combined ratio was 95.2?
Yes.
But that is right in line with their 10-year historical average.
It is. It proves that their pricing algorithms and reserving actions were highly adaptive. While the rest of the industry was bleeding out and posting combined ratios of 105 or 110, Allstate's underlying business was actually humming along perfectly at 95.2.
They just couldn't recognize the profit until they were absolutely certain the inflationary risks had passed.
Precise.
That completely flips the narrative. I mean, it means the 83.3 combined ratio we are seeing today isn't just an accounting trick. It is the delayed reward for exercising extreme discipline when everyone else was panicking.
Exactly.
But I want to move past the historical reserves because the backward-looking accounting only tells half the story. I want to look at the fundamental pricing power they have right now, today, on new business.
Oh, absolutely. Let's talk about the margin gap.
Because the margin gap laid out in the earnings call is just staggering. They stated that the average annualized auto premium per policy right now is sitting at $1,486.
That is the hard cash they're collecting from the average driver over a 12-month period.
Right. But their adjusted underlying loss and expense per policy, like the actual fully loaded cost to ensure the driver is only $1,337.
That is a spread of almost $150 per policy in pure operational margin.
When you multiply $150 by tens of millions of active policies, you really start to understand the sheer velocity of the cash flow generation we are witnessing here.
It's massive.
But how are they doing that? I mean, we know inflation has cooled, but it hasn't disappeared completely.
Yeah.
Medical costs are still rising.
Right.
Labor rates at body shops haven't gone down. They just stopped going up as fast. So how is Allstate widening that gap between the $1,400 premium and the $1,300 cost so efficiently? It can't just be about charging the customer more money forever.
No, it isn't. And this brings us to what I believe is the most critical, forward-looking part of the entire Allstate investment thesis.
Okay, well, let's hear it.
Management dedicated a significant, highly detailed portion of the call to outlining their evolution from a traditional insurance carrier into a massive tech-driven operation. They are actively structurally lowering that $1,337 cost basis using technology.
Ah, yes, the centerpiece of this transformation. They call it ALLE, right? A-L-L-E-E.
Yes, which stands for Allstate's Large Language Intelligence Ecosystem.
If we connect this to the broader macroeconomic trends of enterprise technology, this feels like a defining moment. Management was very deliberate, almost philosophical in how they phrased this evolution.
They were. They explicitly stated that they're building a, quote, technology-driven strategy, not a strategy supported by technology.
I caught that phrasing too. The CEO specifically pointed out that the difference might sound subtle, like corporate semantics, but in execution, it completely changes the DNA of the company.
It really does.
So what does that actually mean for you, the retail investor, trying to model their future expenses?
Well, think of it this way. A strategist supported by technology means the executive team decides how they want to sell insurance and handle claims in a traditional way. And then they walk down the hall to the IT department and ask them to build an app or a database to make that traditional process slightly faster.
The business model dictates the technology. Like putting a digital PDF form on a website instead of mailing a paper form. It's the exact same old process, just digitized.
Exactly. But a technology-driven strategy flips the paradigm entirely. It means you look at the raw, cutting-edge technological capabilities first. What can massive scale AI do? What can real-time big data analysis do? And you build your entire business model, your workflows and your customer interactions around those specific capabilities to maximize efficiency and returns.
So the technology dictates the business model.
Precisely.
So let's put some hard data to this, because the numbers they dropped regarding their tech stack are frankly mind-blowing. We aren't talking about a few servers in a basement in Chicago here.
No, not at all. They stated they are currently leveraging over 40 petabytes of proprietary data.
40 petabytes.
Yeah. To give you context for how massive that is, 1 petabyte is roughly equivalent to 500 billion pages of standard printed text.
That is an almost incomprehensible volume of data.
It is. And it's not generic internet data either. It is highly specific proprietary data on driving habits, claims histories, hyperlocal pricing models, weather patterns, telematics from their DriveWise app, and deeply granular customer behaviors extending back decades.
It is a massive historical ledger of human risk.
That's a great way to put it. And they aren't just storing it. They are actively feeding those 40 petabytes into over 250 highly sophisticated analytical AI models.
250 models.
Yes, and they're burning through 1.5 billion CPU compute hours. They use this computational platform to generate over 100 million insurance quotes and process 50 million sales leads.
And they're frequently executing these complex risk calculations with sub-second response times, right?
Exactly. The sheer scale is impressive, but what is truly fascinating is how they are utilizing this massive computational foundation to deploy Alley. They emphasize that Alley is designed to leverage what they called agentic AI.
Okay, we need to stop here and clearly define agentic AI.
Yeah, that's important.
Because when the average retail investor hears the acronym AI, they immediately think of ChatGPT writing a college essay or, generating a funny picture of a cat. We need to explain how this is fundamentally different.
It is a critical distinction. Generative AI, like ChatGPT, is designed to generate text, code, or images based on a prompt. It is essentially an incredibly sophisticated autocomplete.
Right.
Agentic AI, on the other hand, is an artificial intelligence architecture that can actually take independent actions. It operates as a semi-autonomous agent within a digital environment.
So it doesn't just answer questions, it actually executes workflows.
Exactly. The architecture of Alley has 8 integrated components that enable complex agent-to-agent processing. Instead of a single AI model trying to do everything, they have specialized agents.
Oh, that makes sense.
Yeah. For example, one AI agent is specifically trained to handle initial customer interactions and extract data. Another AI agent is trained exclusively on parsing medical bills for bodily injury claims. Another agent handles the routing of tow trucks and repair authorizations. Another handles real-time dynamic pricing.
So how do they actually work together to lower that expense ratio we talked about earlier? Give me a concrete scenario, like walk me through a car crash.
Okay, let's say an Allstate customer gets into a fender bender and uploads 3 photos of a smashed bumper to the app. In a legacy system, those photos sit in a digital queue for 2 days until a human claims adjuster who makes $80,000 a year opens the file.
Right.
That adjuster looks at the photos, manually estimates the damage, types up a report, and routes it to a local body shop.
A highly manual, highly expensive, and highly slow process.
But with Alley and agentic AI, the workflow changes completely. The customer uploads the photos. Agent A instantly analyzes the pixels, cross-references the damage with millions of similar crash photos from the 40-petabyte database, and accurately estimates the repair cost at $1,200.
Wow, instantly.
Instantly. Then Agent A communicates with Agent B, which checks the customer's specific policy limits and deductibles. Agent B confirms coverage and communicates with Agent C, which queries local in-network body shops for immediate availability.
And then what?
Agent C then automatically routes the approval to the shop and issues the digital payout to the customer's bank account.
And this all happens without a single human touching the file.
Exactly. A process that used to take 3 days and cost hundreds of dollars in human labor overhead is now executed autonomously in 0.8 seconds at a fraction of a cent in compute cost.
That is how you drive down the expense ratio.
Yes.
That is how you widen the margin gap, by removing the friction and the labor cost from routine transactions.
Yeah.
That makes perfect sense conceptually. But let me throw a wrench into this futuristic vision for a second.
All right, throw it.
The reality of legacy financial companies, banks, insurers, airlines, is that they are notoriously built on ancient, clunky computer systems from the 80s and 90s.
Oh, yeah.
They have massive, monolithic COBOL mainframes buried somewhere that process the actual financial transactions. So how on earth does this shiny, futuristic, agentic AI talk to a 30-year-old mainframe without the entire system crashing?
That is the multi-billion-dollar question, and it was actually brought up directly by an analyst during the Q&A session.
Really?
Yeah, and the CEO, Tom, addressed it brilliantly. He explained that Allstate realized years ago that they couldn't just rip out and replace all their legacy core operating systems.
Because it would take a decade and cost billions.
Exactly. And the operational risk of a catastrophic failure would be way too high.
So if you can't replace the old plumbing, how do you attach the new fixtures?
You build a translation layer. The CEO explained that over the last few years, under their broader transformative growth initiative, they spend massive amounts of capital and engineering hours building an orchestration layer.
It's an orchestration layer.
Yeah. They systematically forced all their disparate, ancient legacy systems to expose their data and functions via API's application programming interfaces.
Okay, an API orchestration layer. For the non-engineers listening, an API is basically a standardized digital doorway. It allows two completely different software programs to talk to each other and exchange data securely.
Precisely. This orchestration layer acts as a universal translator that sits squarely between the old, dusty transaction servers and the new, highly dynamic Alley AI interface.
So the AI doesn't need to know how to speak 1990s mainframe code.
Nope.
It just speaks to the API, and the API translates the request and reaches down into the mainframe to pull the customer file or execute the payment.
And here is the strategic brilliance of that move. The CEO noted that they undertook this massive API plumbing project years ago, long before ChatGPT or agentic AI was even a blip on the public radar.
They did it simply because modernizing their architecture was good, fundamental business practice.
Exactly. But now, because that foundational plumbing is already fully built and operational, they are perfectly positioned to plug Alley directly into their core business instantly.
They can deploy advanced AI exponentially faster than their legacy competitors, who are just now waking up to the AI revolution and realizing their mainframes are completely isolated.
Yeah, they have a massive head start.
I love how the CEO cynically joked during the call that a legacy system is usually just defined as the software system you turned on yesterday.
It highlights the reality that enterprise tech is a constant state of adaptation. You are never actually done upgrading.
But deploying AI at this scale on proprietary data raises a massive existential risk, which the analysts press them on intensely cybersecurity and data leakage.
Oh, right, because an analyst literally asked the management team, are you worried about protecting your underwriting tools from these large language models?
The fear is obvious. If you feed your 40 petabytes of top-secret actuarial data and hyper-specific pricing formulas into an AI model, what happens if that model leaks your secrets to the public?
Or worse, what if that data gets scooped up into the training set of a public AI model, and suddenly your biggest competitor can just ask an AI how Allstate prices risk in Florida?
Yeah, that would be disastrous. Management's response to this threat was swift and definitive, though.
They stated explicitly that they utilize highly secure internal proprietary large language models. They do not run their core enterprise operations on public models like the open versions of ChatGPT or Claude.
They have built a walled garden.
Completely. Because the LLMs are hosted internally and ring-fenced within their own server architecture, there is zero risk of their proprietary pricing data being exfiltrated or inadvertently ingested into the training data of a public third-party model.
So their 40 petabyte data moat remains entirely impenetrable to competitors.
Yes.
Although the CEO did have a rather profound, almost philosophical moment during that answer. He expressed a broader macroeconomic concern about the future of agentic AI.
Yeah, he worried aloud about autonomous AI models eventually breaking out of their silos, interacting with the open internet, and teaching other agents how to act independently in ways humans can't predict.
He actually called it an issue the entire country is going to have to deal with on a regulatory level, even while asserting that Allstate is strictly managing their own internal models.
It is wild that we are talking about autonomous AI breaking containment and self-replicating on a quarterly property and casualty insurance earnings call.
Right. It just shows how violently fast this technological landscape is shifting and how aggressively Allstate is leaning into it.
It really does. But as fascinating as the technology is, we have to bring the analysis back to the core financials and the investment thesis.
Good point. We know they have massive anomalous margins today. We know they have this incredible AI efficiency engine kicking into high gear to lower long-term expenses.
Yeah.
But the market is forward-looking.
Right. What is management signaling for the future of the business?
Which brings us to the most aggressive pivot in the entire transcript management guidance. This is where the narrative firmly shifts from a story of post-pandemic recovery and defensive reserving into a story of raw, aggressive offense.
The signal they sent the market regarding their growth strategy was incredibly loud.
It was deafening because there was one specific detail in this transcript that made me do a complete double take. It involves pricing.
Yeah.
If you have paid an auto insurance bill in the last 3 years, you know that rates have gone in exactly one direction, straight up, relentlessly.
Everyone's premiums went up.
Every major carrier has been hitting consumers with massive rate hikes just to keep their heads above water. But here is Allstate, standing in the podium, announcing to the world that in the second quarter, the net implemented rate changes across 36 different locations was exactly 0%.
Zero. Flat pricing across a massive swath of their footprint.
Zero. They didn't hike rates at all in those markets. Why?
It is the ultimate undeniable display of pricing power and total margin confidence. The reason they are flatlining prices on consumers is that their margins are already incredibly healthy.
Remember that $150 spread we discussed earlier between the premium and the cost?
Right. They are already making a phenomenal return on the current price. They don't need to antagonize the customer and squeeze them for another $50 just to make the quarter look good.
Exactly. And by deliberately holding the line on price while competitors are still scrambling to push through rate hikes, Allstate is executing perfectly on the core philosophy of their master plan,
which they call transformative growth.
Let's define transformative growth, because it is the buzzword that dictates their entire corporate strategy right now.
Fundamentally, transformative growth is a strategy that relies on prioritizing market share growth over sheer price increases.
Because their technological efficiencies and predictive reserving have given them such a low-cost basis, they have massive pricing flexibility.
They can afford to be incredibly competitive on price without sacrificing their underlying profitability.
And when you have a recognizable, trusted brand name like Allstate, and your price is suddenly highly competitive compared to Geico, Progressive, or State Farm, you don't just retain your current customers.
No, you actively steal market share from your rivals.
And we see the undeniable proof of that thesis working in the raw growth data. Total policies in force, which is the absolute total number of active insurance policies they manage, increased by 3.8% year over year,
bringing the total to nearly 216 million policies.
Adding 3.8% volume to a base of hundreds of millions of policies is massive growth for a mature mega-cap company.
It is, and crucially, they are driving this growth not just in one niche area, but across every single distribution channel they operate in.
Let's break down those distribution channels, because understanding how insurance is actually sold is critical to understanding the breadth of Allstate's reach. The insurance consumer market isn't a single monolith.
No, different demographics want to buy insurance in fundamentally different ways.
The CEO made a really sharp, intuitive point about this market segmentation during the call. He argued that a consumer's choice of how to buy insurance ultimately boils down to a matrix of two questions.
How much professional help do you want, and how much do you care about the absolute lowest cost?
Let's map those two questions onto Allstate's three main distribution channels. Let's start with the direct channel.
The direct channel serves the highly price-sensitive, highly autonomous customer. This is the person buying insurance online or through an app.
This customer does not want a lot of hand-holding. They don't want to chat with an agent about their life goals.
Right. They want to log on, input their vehicle identification number, get a fast quote, and buy the policy as cheaply as mathematically possible.
And the CEO noted something fascinating about the economics of this specific channel. He stated that Allstate sells the exact same underlying auto insurance product in the direct channel that they sell through their physical agents, but the policy is priced 7% cheaper in the direct channel.
Which naturally leads to the question, why would they cannibalize their own pricing by 7%?
Because selling direct completely eliminates the cost of paying an agent's commission. The customer is doing the data entry themselves. So Allstate passes the massive savings on commission overhead directly back to the consumer in the form of a 7% discount.
Making the product hyper-competitive against direct-only rivals like Geico.
But the direct channel is an absolute knife fight. It is incredibly competitive, driven heavily by massive television advertising budgets and digital marketing algorithms.
It is entirely a game of customer acquisition cost versus lifetime value. And this is exactly where those 50 million digital leads and the sub-second response times from the Alley tech stack come into play.
If a customer searches for auto insurance on Google, Allstate's AI needs to instantly calculate their risk profile and deliver a binding quote before the customer clicks away to a competitor's site.
It is high-speed algorithmic warfare.
But then, on the complete opposite end of the spectrum, you have a totally different type of customer. The one who uses an independent agent.
Right, the independent agent channel. These are customers who implicitly distrust large insurance corporations. They don't want to spend their weekend researching coverages online.
They want to walk into a local broker's office and say, I need insurance. Please shop my profile across 5 different carriers and find me the best combination of price and coverage.
The customer perceives the independent agent as an objective advocate fighting for them.
Exactly. And Allstate has been aggressively growing its presence in this channel. This growth was largely supercharged by their $4 billion acquisition of National General a few years ago.
That acquisition wasn't just about buying revenue. It gave Allstate massive instant credibility, specialized underwriting infrastructure, and deep relationships in the independent agent space.
Customers who use independent agents are generally less price sensitive than direct buyers. They are willing to pay a slightly higher premium for that localized expertise and the perceived objectivity of the broker doing the legwork for them.
And then sitting right in the middle of this matrix, you have the classic Allstate exclusive agent.
The captive agent, the person whose name is physically on the sign above the strip mall office in your hometown.
These customers represent the historical core of Allstate's business. They want professional guidance, they want someone to explain their coverage limits, but they deeply believe in the financial strength and reliability of the Allstate brand itself.
They aren't looking to shop their policy around to a new, unknown carrier every 6 months to save $10. They want a long-term relationship with a local business owner they trust.
And what I found so compelling during the Q&A portion of the call was when an analyst asked about how they manage local competition across these channels. Jess, the head of property liability, gave a masterclass answer using the state of Illinois as a real-world case study.
Yeah, she explained how they attack a specific geography using all 3 channels simultaneously without cannibalizing themselves.
It was a perfect illustration of their operational strategy. She explained that in Illinois, their internal data showed they had significant room to grow market share. So they deployed a centralized go-to-market team that optimizes their attack across the board.
How does that look in practice?
Well, in the direct channel, they don't just blast generic ads. They use highly targeted, demographically segmented digital marketing dollars to aggressively acquire price-sensitive customers precisely where the algorithmic return on investment is highest.
Okay, so that's the direct channel.
Simultaneously, in the independent agent channel, they are rolling out new Custom 360 bundled auto and home products, specifically designed to give those independent brokers the exact tools they need to win head-to-head against competing carriers' products.
But the most radical changes are happening with the exclusive captive agents. They're completely changing the daily workflow of the traditional insurance agent.
Jess noted that they are aggressively utilizing technology to strip routine service tasks entirely off the agent's plates.
This is a huge shift in operational efficiency. If an existing customer just needs to change their mailing address, add a new teenage driver to the policy, or pay a monthly bill, the highly paid, highly skilled local agent shouldn't be wasting 15 minutes on the phone handling that administrative data entry.
Right. The Alley AI systems and the mobile app handle the routine administration flawlessly.
The tech handles the friction, which frees up the exclusive agent to do what they actually do best.
Build deep interpersonal relationships, conduct annual financial reviews, identify new risk needs, and cross-sell high-margin products like life insurance, commercial policies for small businesses, or complex umbrella liabilities.
Furthermore, management highlighted that they're giving these exclusive agents unprecedented operational flexibility regarding their physical overhead.
Historically, if you were an Allstate agent, you were required to lease a traditional, expensive retail storefront.
Now, if an agent wants to operate entirely virtually or in a shared co-working space to drastically lower their real estate costs, Allstate is providing the digital tools to allow that.
This structurally lowers the operating costs for the agent, making the exclusive agent model far more profitable and highly attractive when recruiting top sales talent away from competitors.
It's a holistic, multi-pronged attack on market share that leverages technology to optimize every single touch point. And the raw new business growth numbers prove undeniably that this strategy is working.
The numbers are explosive. Auto insurance new business hit 2.3 million items in the quarter.
To put that in perspective, just 3 years ago, that number was only 1.5 million. That is tremendous, accelerating growth.
And it's not just auto. Homeowners' new business surged an unbelievable 46.8% to over 411,000 policies.
And it is crucial to note that they aren't just selling monoline policies. A monoline policy is when a customer only buys one single product, like just auto insurance.
Right. Allstate is highly focused on driving bundled products, convincing the customer to bring their auto, their home, and their umbrella policy all under the Allstate roof.
Because the economics of a bundled customer are vastly superior.
Exponentially superior. When a customer bundles multiple complex policies, the friction of moving all those policies to a competitor becomes extremely high. Retention rates skyrocket.
And because the customer stays longer, the lifetime value of that specific customer massively increases, heavily offsetting the initial customer acquisition cost.
Which brings up a fantastic, slightly terrifying question raised by one of the analysts on the call.
Yeah.
With all this massive 46% growth in property and homeowners insurance, aren't they actively taking on massive concentrated catastrophe risk?
Oh, right. If a Category 5 hurricane hits Florida or massive wildfires sweep through California, isn't this rapidly growing book of business going to generate billions in catastrophic claims and wipe out all these beautiful underwriting profits?
It's a critical risk factor, perhaps the biggest existential threat to any property insurer. But management addressed it head on, and their answer provided deep insight into their risk management framework.
The CEO stated frankly that Allstate is likely the single biggest U.S. buyer of property liability catastrophe reinsurance.
Let's explain reinsurance, because it is the hidden shock absorber of the global financial system.
Reinsurance is quite literally insurance for insurance companies.
Exactly. Allstate takes a portion of the premiums they collect from homeowners, and they pay those premiums to massive global reinsurers companies like Swiss Re or Munich Re.
In exchange, those global reinsurers sign treaties agreeing to cap Allstate's downside risk in the event of a massive multi-billion-dollar natural disaster.
So Allstate might say, we will cover the first $500 million of hurricane damage out of our own pocket. But if the storm damage exceeds that attachment point and hits $2 billion, the global reinsurers are contractually obligated to pay the remaining $1.5 billion.
They have a highly sophisticated, heavily capitalized, multi-layered reinsurance program in place. It acts as an absolute ceiling on their catastrophic losses, ensuring that their aggressive strategy to grow the highly profitable homeowners business doesn't inadvertently translate into unmanageable company-killing volatility when a natural disaster inevitably strikes.
It's like they have built a financial fortress.
And speaking of a fortress, we have to pivot and talk about the balance sheet. Because as a retail investor, this is the ultimate bottom line question.
What is management actually doing with all this cash they are generating if they aren't paying it out in claims?
This is where the capital allocation strategy becomes the real driver of long-term shareholder value. The operational metrics are great, but how they deploy the resulting cash determines the stock price.
And right now, Allstate is sitting on $9.5 billion in deployable capital at the holding company level.
Let's pause and define what deployable capital at the holding company actually means, because insurance accounting has strictly regulated silos.
It is a vital distinction. An insurance company is actually a structure of nested entities. The operating companies are the entities that actually write the insurance policies and hold the reserves to pay claims.
State regulators require these operating companies to hold a massive amount of statutory surplus capital to ensure they remain solvent. That capital is trapped. Management cannot touch it.
But when those operating companies generate profits above and beyond what their regulators require, they pay those profits upward as dividends to the parent holding company.
Correct. So the $9.5 billion we are talking about is sitting at the holding company level. It is completely unrestricted, highly liquid dry powder.
It has cleared all regulatory hurdles. Management can do whatever they want with it.
$9.5 billion of deployable cash. Let's frame that for you. Based on their current share count, that equates to approximately $37 per single common share outstanding, just sitting in the corporate checking account ready to be deployed.
And management is certainly not being shy about returning that massive pile of cash directly to the owners of the company. During the second quarter alone, they returned $1.3 billion to shareholders.
This capital return included a massive $1 billion share repurchase program executed in a single 90-day period.
$1 billion in stock buybacks in one quarter.
And they still have $2.6 billion remaining on their current $4 billion repurchase authorization that the board approved back in February.
If we pull back and look at the historical context of their buyback strategy, the math is truly astounding. The earnings call highlighted that over the last decade, Allstate has systematically repurchased 39% of its entire outstanding share count.
I need you to really let that math sink in. Nearly 4 out of every 10 shares of Allstate that existed a decade ago have been bought back by the company and permanently retired.
And the mathematical effect of that is incredibly powerful. Even if the company's total net income never grew by a single dollar, the earnings per share would skyrocket because those earnings are being divided by a drastically smaller number of shares.
Exactly. It artificially but wonderfully inflates the earnings per share and the intrinsic value of every single remaining share. If you are a long-term shareholder who just held on and did nothing, your proportional slice of the entire company got nearly 40% bigger without you ever having to invest another dime.
It is the miracle of a shrinking float, and the sheer scale of the capital returned is staggering.
The total cash returned to shareholders via dividends and share buybacks over that 10-year period was literally equal to Allstate's entire total market capitalization back in 2015.
They generated so much cash, they essentially bought their entire company back over a decade while continuing to grow operations.
But buybacks aren't the only tool in the shed. I am usually highly critical of companies that just blindly buy back stock regardless of valuation, because it often signals that management lacks imagination or has zero innovative ideas for growth.
But Allstate actually has a proven history of highly strategic, highly accretive M&A acquisitions.
Yes, and the CEO specifically addressed this capital allocation philosophy. He mentioned that management views capital deployment through a strict enterprise risk and return lens.
When they see an opportunity to deploy capital into an acquisition that will yield a fundamentally higher internal rate of return than buying back their own stock, they pull the trigger.
He pointed to 2 massive historical wins to prove this: Point Square Trade and National General.
Oh, let's talk about Square Trade, because that acquisition completely shifted my perspective on what Allstate actually is.
Square Trade is the company that sells those extended warranty protection plans when you buy a flat screen TV at Costco or a laptop at Target or a smartphone online, right?
Correct. It is point-of-sale consumer electronics and appliance protection. Several years ago, Allstate identified that this adjacent market had high margins and low capital requirements compared to heavy auto insurance. They bought Square Trade for $1.4 billion.
A massive swing.
A massive swing that paid off brilliantly. Today, the CEO noted that Square Trade is more than 10 times its original size. It generated over $80 million in pure profit just in the first 6 months of this year alone.
More importantly, It gave Allstate massive immediate brand reach into the point-of-sale retail market, diversifying their revenue streams away from traditional property and casualty risks.
And what about National General? We mentioned them earlier regarding the independent agent channel.
National General was an even bigger swing. They paid $4 billion gross for National General.
The strategic rationale was twofold. It immediately gave Allstate a massive pre-built technological footprint and deep broker relationships in the highly fragmented independent agent channel.
And it gave them highly specialized actuarial expertise in the non-standard auto insurance market, which covers higher-risk drivers who require specialized pricing algorithms.
And how has that asset performed?
Flawlessly. The CEO stated that today, the National General business they acquired has more than doubled in size under the Allstate umbrella.
So they aren't just blindly hoarding cash and treasury bills, and they aren't just artificially juicing EPS with mindless buybacks. They are actively making highly accretive acquisitions that bolt perfectly onto their core competencies.
And on top of the underwriting profits and the acquisitions, we absolutely cannot forget the third engine of this cash-generating machine.
The investment portfolio.
Right. We have to remember that massive insurance companies are fundamentally giant investment funds that use insurance premiums as their zero cost or negative cost capital base.
The legendary concept of float, made famous by Warren Buffett.
Exactly. When Allstate collects that $1,400 premium today, but doesn't have to pay out a claim for 18 months, they don't just put that cash under a mattress. They invest it.
And Allstate's investment portfolio is gargantuan. It generated an incredible $1 billion in pure net investment income this quarter alone.
$1 billion in investment income in 90 days.
Yes, which represents an increase of almost 34% from the prior year's quarter.
How did they generate a 34% jump in investment yields? Did they take on massive credit risk and start buying junk bonds?
No, it was a highly calculated macroeconomic play on interest rates. Management explained that they proactively lengthened the duration of their fixed income bond portfolio when bond yields peaked and were highly attractive.
Let's explain duration risk briefly for you guys listening.
Duration measures how sensitive a bond's price is to changes in interest rates. By shifting their massive portfolio into longer duration bonds when interest rates were at their cyclical highs, they locked in those high fixed yields for years to come.
Now, even if the Federal Reserve starts cutting interest rates aggressively, Allstate will continue to collect those locked-in, high-yield coupon payments, securing a massive, predictable stream of investment income regardless of macroeconomic rate volatility.
It is brilliant treasury management. And they didn't just win on bonds.
No, they also made a major move in equities. Management noted that they deliberately increased their public equity investments, meaning stocks, by $7.1 billion over the last year.
As the broader stock market rallied significantly, that equity portfolio experienced massive mark-to-market valuation gains, further supercharging the total return of the portfolio.
So to summarize the entire operational picture here, they're winning massively on the core underwriting side by keeping combined ratios in the 80s.
They are winning on the technological side by deploying agentic AI to permanently lower their expense ratios.
They are winning on the investment side by locking in peak bond yields and riding the equity rally. And they are aggressively returning that resulting tsunami of capital to shareholders through massive buybacks.
We have dissected the raw numbers, we have analyzed the macroeconomic context, and we have unpacked the strategic guidance. It is time to bring all of this exhaustive data together and distill it into an actionable conclusion for your portfolio. Let's synthesize the bottom line.
I am going to take a highly definitive, deeply opinionated stance here. I am wildly, unequivocally bullish on this quarter and the strategic direction of this company.
It's hard not to be.
The numbers presented in this transcript are an absolute, undeniable flex for management. The entire property and casualty insurance industry went through absolute hell over the last 3 years.
The post-pandemic inflation nightmare, the supply chain collapse, the used car price spikes, the labor shortages, they crushed profit margins across the board.
A lot of legacy companies were caught completely flat-footed, deeply under-reserving for claims and bleeding capital. But Allstate proved definitively that they have successfully navigated the storm.
They adapted their pricing models faster, they modeled their reserves with extreme conservative discipline, and now, as the macro environment normalizes, they are reaping monumental rewards.
Looking at the data objectively, it is very difficult to disagree with that bullish assessment.
If you are a retail investor currently holding the ticker, or if you are eyeing it for a potential position, the fundamental signal embedded in this earnings call is remarkably strong.
This stock is currently operating as a highly efficient, highly adaptive cash printing machine. The underlying combined ratio of 79.4, if you strip out catastrophe losses, is absolutely pristine.
They are heavily systematically rewarding shareholders through massive, consistent buybacks that mathematically force the intrinsic value per share higher.
They have $9.5 billion in unrestricted deployable capital sitting at the holding company ready for future strategic acquisitions, massive technology investments, or further aggressive share repurchases.
And most importantly, they are actually growing the top line. They aren't just squeezing existing customers with endless rate hikes. They are holding prices flat, leveraging their technological cost advantages, and aggressively writing highly profitable new volume across every single distribution channel they operate in.
It is a textbook academic example of operational leverage in a financial institution. However, as rigorous analysts, we have a duty to present a fully balanced view.
No investment is without risk. We must clearly define the bear case scenario. What are the specific variables that could derail this incredible momentum and break the thesis?
Right. If we were playing devil's advocate, what is the crack in the armor?
The primary operational risk, which was openly acknowledged by management during the Q&A session, revolves around severity trends, specifically regarding bodily injury claims.
Okay, let's unpack that.
While inflation on physical damage, the cost of replacement parts, the cost of used cars, the cost of labor at body shops has undeniably cooled, which drove those massive reserve releases, the severity and absolute cost of medical care, and the subsequent litigation associated with bodily injury claims remains stubbornly high, and in some regions, it is accelerating.
Yeah. The management team explicitly mentioned the devastating impact of what they call social inflation, heavily driven by third-party litigation funding and ubiquitous billboard lawyers relentlessly driving up jury verdicts and settlement costs.
Exactly. When plaintiff attorneys take more aggressive tactics, settlements balloon, and those costs are borne entirely by the insurer. Now, management noted they are highly hopeful for legislative tort reform in traditionally difficult states like New York, Florida, Georgia, and Louisiana.
They're lobbying for laws that cap damages or limit attorney fees, but hope is never a viable investment strategy.
Precisely. If legislative tort reform fails to materialize and litigation costs spike unexpectedly, or if broader healthcare and medical inflation suddenly surges again, that pristine 83.3 combined ratio could very quickly start creeping back up toward the high 90s.
Which would rapidly compress those massive underwriting margins.
That is undeniably the key variable to monitor. As the pure premium trend develops and the actual claims data rolls in during the back half of the year, investors need to watch like a hawk to see whether bodily injury severities start to outpace the immense pricing power Allstate currently enjoys.
But it's crucial to note that as of this specific quarter, given the sheer size of the margin gap we discussed, their margin of safety is incredibly wide. They have a massive buffer to absorb slight upticks in severity before it truly threatens profitability.
It is a margin of safety wide enough to drive a fleet of fully insured commercial trucks through.
It really is simply a phenomenal historic quarter. Which brings us to the end of our deep dive analysis. But before we sign off, I want to leave you with a final, provocative thought to mull over. Something that builds directly on the data we've discussed today, but stretches the implications far into the future of the entire global financial sector.
I think we are looking at the leading edge of a massive paradigm shift in what fundamentally constitutes an economic moat in the 21st century.
Exactly. Let's think deeply about the intersection of advanced AI and legacy finance. We spent a significant amount of time unpacking the architecture of LE. We detailed how Allstate is successfully deploying fully autonomous agentic AI across a staggering 40 petabytes of hyper-specific, proprietary historical data to dynamically price risk, autonomously route complex claims workflows, and handle millions of customer interactions with sub-second latency.
Which, again, is an almost incomprehensible technological achievement for an insurance company founded during the Great Depression in 1931.
But the provocative question is, what does this technological leap mean for the rest of the industry? Are we rapidly entering an era where smaller, regional, or mid-tier insurers, the companies that simply do not possess 40 petabytes of pristine historical data, the companies that cannot afford to purchase 1.5 billion CPU compute hours, the companies that don't have the engineering capital to build complex API orchestration layers, are they simply doomed?
This raises a profound question about the inevitability of massive market consolidation. The fundamental rule of machine learning is that AI requires massive, pristine, highly labeled data sets to train effectively.
Therefore, the companies with the absolute biggest, most historically rich data sets will inevitably build the smartest, fastest, most efficient AI agents.
It is a compounding, insurmountable advantage.
Right. Think about the real-world implications of that algorithmic superiority. If Allstate's heavily trained agentic AI can instantly calculate a specific driver's risk profile down to the exact penny in real time, while a smaller regional competitor is still relying on slow Excel spreadsheets and generalized outdated demographic tables, that smaller competitor is going to get mercilessly picked apart by adverse selection.
The mechanism of their defeat is mathematically certain. The smaller, less technologically advanced insurer will accidentally overprice the safe, highly profitable drivers, causing those drivers to immediately flee to Allstate's cheaper AI-optimized rates. Simultaneously, the smaller insurer will accidentally underprice the dangerous, high-risk drivers, attracting all the bad business in the market and ultimately getting crushed by a wave of massive claims they didn't properly reserve for.
Is massive proprietary data scale the new, ultimate, impenetrable economic moat in property and casualty insurance?
For a century, the primary barrier to entry in insurance was simply having enough financial capital, enough raw cash to legally satisfy state regulators and pay out catastrophic claims. Has that barrier now permanently shifted? Is having enough financial capital no longer enough if you don't possess the immense technological capital required to compete on pure algorithmic efficiency?
It certainly appears that the nature of competition has permanently, fundamentally altered. The data suggests that capital alone cannot overcome a massive deficit in predictive modeling and operational automation. It really makes you wonder if, 5 or 10 years from now, the entire global insurance industry is just going to consolidate into 3 or 4 mega giants wielding massive supercomputers and impenetrable data silos, while every other mid-tier carrier simply gets priced out of existence or acquired for parts.
It is a wild, slightly dystopian, but highly profitable thought to take back to your portfolio analysis. Because in our analogy at the top of the show, the mechanic didn't just hand you a briefcase full of cash and fix the car. He completely structurally re-engineered the engine while you weren't looking.
And right now, that engine is purring flawlessly.
It certainly is. The sheer operational excellence displayed in this quarter is a new, incredibly high benchmark for the entire industry to attempt to meet.
Well, that is all the time we have for today's deep dive into Allstate's Q2 2026 earnings call. Thank you for joining us, for unpacking the complex actuarial data with us, and for letting us translate the noise of Wall Street into actionable fundamental insights.
Keep researching the mechanics of your holdings. Keep asking the hard, skeptical questions of management teams. And most importantly, keep your portfolio sharp.
We will see you on the next deep dive.